Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at NASDAQ. Joining me live at MarketSite is Kevin McPartland. He's the head of Market Structure and Technology Research at Greenwich Associates. Kevin, thank you as always for joining us.
Yeah, thanks for having me.
Super excited to get your 2018 market structure outlook. And let's get into the first topic about product agnostic investing. How is that helping managers identify the best way to execute their ideas?
Yeah, so I know that's a bit of a mouthful, but really what we're talking about is if you need to get some kind of exposure, equities, interest rates, credit, whatever it is, there generally are a number of products that are available to do that, right? So if you're looking at the rates market, you could use futures, you could use swaps, you could use government bonds. So what's the best choice? And today, for the most part, when investors look to get that exposure, the PM says buy this bond or execute this futures order, rather than saying, okay, how do I change my duration or how do I get credit exposure? So we're seeing that sort of going into 2018, there should be more of a push to systematically thinking through that process, to figure out, take into account fees and liquidity and a whole host of other issues to get the best execution for the exposure, not just going to a particular instrument.
All right, well, the big question is, does data matter more than trading at this point?
Yeah, so data is definitely going to continue to be a big topic in 2018. We saw that in 2017. You and I have spoken about the use of alternative data. As we go into 2018, a lot of the trading venues, particularly in fixed income, but also in equities, are pushing, in some ways more than their trading platforms, they're pushing the innovations around data, the data that they can make available, the analytics related to that data, helping traders to make decisions, to find opportunities for investing. So if you look across the gamut for bond investors, I said for equity investors, figuring out how to take the unique data sets that all of those venues have, and not just providing it to their users, but also helping them to analyze it and make sense of it and to understand the landscape. And as I said, to find investment opportunities.
Right. And for 2018, do you think alternative data will become more accessible? And where's the challenge with helping market participants use it effectively?
Yeah, so alternative data is becoming more accessible, that's for sure. The trick with alternative data, however, as I think we've discussed in the past, is once it becomes widely available, it's not all that alternative anymore, right? So we talked about social media, using the Twitter feed. It's so common that even in certain retail applications, retail investors are looking at Twitter sentiment around stocks. I'm not sure that can be considered alternative if it's that widespread. So while alternative data is becoming more accessible, it's a little confusing in that makes it not all that interesting to investors anymore. But the upside is alternative data as a thing is almost endless, right? The world is creating so much data every day from so many new sources that we never would have thought of in the past. It's really just up to the creativity of both the providers and the investors to figure out how to use it and how to seek out sort of new investment ideas from that data.
Well, let's talk about the active versus passive debate. And you made this point that if enough money passively tracks a set of indices, then the opportunities for active management will become too hard to resist and a balance will eventually be struck. So are we there yet? And then the second question is, if a fund is truly passive, how can they have management?
Yeah, so we're certainly not there yet. There's still a tremendous amount of growth for passive investing in general, for ETFs more specifically, across asset classes for sure. There ultimately should be a limit. If there's enough money chasing a particular index, that means that same money has come out of another active strategy, which will make those active strategies less crowded over time, that in theory should bring money back over because you could find some returns that you're not finding in following the index. We certainly have some time to go there for sure. The growth in ETF assets under management doesn't seem to stop growing. I'm sure 2018 will be no different for sure. On your second question, I mean, it's a really sort of interesting point. They're passively managed because they're following an index, but there's still a lot of work. There's still a portfolio manager that needs to make sure that portfolio is balanced, that there's no basis risk, that it is truly tracking that index, because in many cases, tracking an index isn't as simple as buying the right proportions of the right securities in that index. It could be buying some of the securities in that index, or maybe in slightly different proportions, or maybe using derivatives to make sure that you're tracking properly. So there is definitely a sort of an active component to passively managing for sure. So passive investing, passive management may be a bit of a misnomer.
Do you think the banks are going to make progress with innovation this year?
Yeah, the banks have made a lot of progress with innovation. Obviously, it feels like we're in another fintech boom that started a few years back. The banks are certainly jumping on board. It does feel a little bit different than maybe 15 years ago when tech felt like a threat. I think people still talk about tech as a threat to the banks, but the banks continue to show that over time they embrace the opportunity, they look at ways they can improve their own processes and get themselves involved in areas where they think they can service their customers better. So banks will continue to build on their own. They will certainly look to buy and invest in innovative technologies. And we want that. That's a tremendous amount of firepower behind some great ideas that can change the industry.
All right, and to wrap up, you also mentioned in the report that we're going to find out what digital really means. What does that mean?
Yeah, it came up so much at the end of 2017, and it made me think back to the late 90s, right? Isn't this something that we figured out in the first dot-com boom, but apparently not? The idea of a chief digital officer, a digital strategy, we're hearing across all of our clients, and it's really about how you interface, how you interact with customers electronically. Just putting up a website really isn't a digital strategy. That's just a website. So that's something that the industry is really rethinking and putting a lot of deep thought into to make sure that that relationship, which is still really the heart of the industry, that the relationship is maintained, even though the method of communication and interacting with that customer is dramatically different.
All right. Well, Kevin, thank you so much, as always, for joining us at MarketSite and for your insight. And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.